Welcome to the Pro Ticker Deep Dive.
Today, we're shifting our focus. We're moving away from the glitz of gold and really diving into the metal that, underpins everything.
It's true. Gold has had just a spectacular run. I mean, it's captured all the headlines, all the nervous capital.
A 60% surge, hitting around, what, $4,100 an ounce?
Exactly. It feels like the only game in town, the currency of fear in this kind of uncertain world.
Right. But if gold is the currency of fear, then you have to think of copper as the currency of civilization. It's the physical foundation, for power, for connectivity.
And we're looking at a stack of sources today that suggest we should be paying a lot less attention to gold's mood swings, really.
And far more to copper's structural revolution.
And the numbers being thrown around are, they're aggressive. This whole deep dive really centers on forecasts that suggest copper could hit a stunning $20,000 per metric ton.
Exactly,
Yeah.
which is a huge jump. Right now, copper's sitting around, what, $11,100 a ton, about $5 a pound.
So moving towards $20,000, that changes everything.
It fundamentally shifts the entire market landscape.
Yeah.
The core thesis is really simple. Copper is entering a structural bull market. It's rooted in mandatory global infrastructure transformation. This isn't about sentiment. It's about physical necessity.
Okay, let's unpack that, because that $20,000 target, let's be real, it sounds a little like a speculative bubble.
It does on the surface.
What's the evidence that the global economy can even sustain that kind of price inflation, especially for a commodity that's known for being volatile?
Well, the evidence checks with historical context. And
Yeah.
the math here is, it's really compelling. If you look at the relationship between gold and copper,
A ratio.
the copper to gold ratio, it just recently hit a 175-year low.
175 years.
I mean, think about that. Copper is dramatically undervalued relative to gold. It's cheaper now than at almost any point since we started keeping this data back in, 1850.
So a 175-year low, that suggests a huge divergence. Gold's gains were driven by market fear, central bank buying.
Right. It's sentiment,
Yeah.
geopolitical stress.
I mean, sentiment can turn on a dime.
Exactly. How quickly can that reverse compared to these, long-term structural pressures? Gold's gains are spectacular, sure, but they could be transient. Copper's potential strength is mandatory. It's tied to infrastructure investments that have already been committed by governments, by big tech. This demand is sticky.
So let's talk about that low. When you say the price needs to normalize, you're talking about mean reversion, right? The historical price relationship snapping back like a rubber band.
That's the simplest way to put it, yeah.
Hmm.
If copper just moved to restore its historical average ratio with gold, it would target somewhere between $18,000 and $22,000 per ton.
And that's without gold having to fall at all.
Not a penny. Suddenly, that aggressive $20,000 forecast, it stops looking like an outlier and starts looking more like just simple math, a reversion from a historic anomaly.
Okay, that puts the whole thing in context. Because you see the big investment banks, they're forecasting $11,000 to $12,000 for 2026. But those bullish cases, the ones pushing toward $15,000 and beyond, they're grounded in this story.
And what's fascinating is that the structural support comes from three distinct, massive shifts
Yeah.
that are all happening at the same time. And copper is right in the middle of all of them. It's a perfect storm of demand.
All right, so let's get into those three unstoppable demand forces. Let's start with the one that was, I guess, completely unexpected until just recently.
That has to be the AI revolution, the data center build-out. I mean, 2 years ago, this level of copper demand wasn't even in the supply models. Now it's a seismic shock.
And these AI data centers use way more copper than traditional ones, right?
Vastly more. A traditional facility might use, say, 5,000 to 15,000 tons of copper. An AI hyperscale facility needs up to 50,000 tons.
50,000. Why
Well-
such a huge difference?
It's all about power. AI workloads require just colossal amounts of high-capacity electrical distribution. You need these massive copper bus bars, these thick conductors moving huge currents, and advanced transmission lines, grounding, cooling.
And the projections for capacity are just immense. The sources say global data center capacity is set to triple by 2030, from 60 gigawatts to over 170, with 70% of that new capacity all for AI.
Think about the scale of that. Estimates suggest AI data centers will consume about 400,000 tons of copper annually for the next decade,
Wow.
peaking at maybe 572,000 tons in 2028. And to give you some context, 400,000 tons is roughly the entire annual copper production of Peru.
So we're basically adding another Peru's worth of demand just for AI.
Just for AI.
Okay, so that's force one, an accelerating, unexpected demand shock. Force two is the energy transition. This is the one everyone knows about, but you call it the unglamorous, copper-voracious megatrend.
Right, because the real story isn't just about a shiny new EV. I mean, sure, every EV has 4 times the copper of a gas car, and wind turbines need 5 to 7 tons each. But the massive driver, the truly huge one, is grid modernization,
The boring stuff.
the boring but essential stuff. We're facing a huge problem. 70% of U.S. power lines are over 25 years old. They have to be replaced or overhauled to handle renewable power.
And that sounds like spending that just can't be deferred.
It can't, and the projections reflect that. Annual copper demand from renewables alone is projected to surge 153%, going from 1.7 million tons today to 4.3 million tons by 2035. That is a massive long-term growth curve that will just crush the available supply.
And then Force 3 is a geographic shift, right? Western infrastructure recovery. China powered the last supercycle, but now its growth is normalizing.
It is. China's share is expected to ease a bit from 57% of global demand down to maybe 52% by 2031. But that demand isn't vanishing, it's just shifting. The U.S., for one. U.S. copper demand is expected to rise nearly 50% by 2031. India's consumption is projected to blow past 1 million tons. That's a 30% plus increase.
And why is that geographic shift so important for keeping prices high?
Because it moves the market away from a China-driven, boom-bust construction cycle to a more durable, steady-state demand in the West and India. It's less about temporary building sprees and more about constant maintenance, grid replacement, new factories. That provides persistent, long-term price support.
Okay, so demand is accelerating on 3 massive separate fronts. That brings us to the other side of the coin, the supply cliff. And the constraint isn't just about volume, it's about time.
Exactly. The structural lag is just brutal. It takes an average of 17 years to open a new copper mine.
17 years.
From discovery through permitting, financing, all the way to production. Now, you put that up against AI demand, which basically started 2 years ago. The math just doesn't work. We are running up against a demand requirement that cannot possibly be met by new mines in the next decade.
And we're already seeing supply growth slowing down even before this demand really hits hard.
Sharply. Global mine supply growth forecasts are being slashed. Because of disruptions, water restrictions, power issues at existing mines, the 2025 growth forecast was cut from 2.3% down to just 1.4%. So we have less supply growth at the exact moment this triple-pronged demand spike is hitting.
Which translates into some big projected deficits. What are the key numbers there?
Well, Goldman Sachs is projecting a deficit of 250,000 metric tons in 2026 alone. Citi is looking at it cumulatively, and estimates demand will outstrip supply by 1 million metric tons over the next 3 years.
1 million tons.
These aren't minor imbalances. These are acute systemic shortages.
And the bottlenecks go beyond just the mine itself, right? The sources mention problems further down the chain.
That's right. Refined production growth is collapsing to just 0.9% in 2026, and that's because of a lack of concentrate and smelter capacity constraints. Even if you could pull more ore out of the ground tomorrow, the smelters that turn it into usable metal can't just ramp up instantly.
So that all just reinforces the high prices. And inventories are the key indicator here, I assume.
They are. They're the visible, physical stock you can draw on. And right now, LME and COMEX inventories are at multi-year lows. The market is balanced on a knife's edge. Even a small supply disruption can trigger a sharp, rapid price rally because there's just no cushion left in the system.
Okay, this is an extremely bullish case. Before we get to the technicals, what could derail this? What's the counter-argument to the $20,000 forecast?
The big one, the black swan, is a genuine, deep global recession that would crater demand across the board. AI build-outs would pause, grid modernization gets delayed.
Copper is cyclical, after all.
It is. A deep downturn would definitely cause a sharp correction.
But even something like a disappointment in China's demand or new tariffs,
Right.
those are more like volatility events, right? They don't solve the long-term deficit.
Correct. Tariffs distort pricing, but they don't create a single extra pound of copper. And while high prices will eventually incentivize new supply, these kinds of structural deficits tend to last for 5 to 7 years before that new supply really hits the market.
All right, let's pivot to the investment outlook. What has the price of copper actually been doing lately?
Well, we saw it hit a record high of $5.24 a pound back in March. Since then, it's settled back and consolidated around the current $5.02 level.
So textbook bull market behavior.
Absolutely. A massive breakout followed by a bit of consolidation. It suggests professional money is building a base for the next move higher. The intermediate-term uptrend is clearly intact.
And what are the key levels people should be watching?
That $5 a pound level, or $11,000 a ton, is now the critical support zone. A move above the prior high of $5.35 a pound would really confirm the breakout is continuing. That opens the door to targets of $5.50, maybe $6 a pound.
So for the listener who's convinced by this, what are the main ways to actually capitalize on this?
You've got, I'd say, four main paths. First, direct commodity exposure through futures, or ETFs. That's a pure play on the price. Second, mining equities companies that are actively expanding production.
And the other two are a bit more diversified.
They are. Third, you've got the big integrated miners who have copper, but also gold or other byproducts. That gives you a bit of a natural hedge. And finally, you can play it thematically through infrastructure or clean energy ETFs. You capture the demand indirectly through the companies that are actually using all this copper.
This has been a really insightful look. The core thesis seems robust. Copper is facing a structural scarcity just as it meets explosive demand from AI, EVs, and grid modernization investments that are, non-negotiable.
And while gold captured everyone's attention, that $20,000 forecast for copper, audacious as it sounds, is really underpinned by that 175-year low valuation relative to gold. If that ratio just normalizes, copper could easily double from here.
So the question for you, the listener, isn't just will copper go up, but maybe if copper does hit $20,000 a ton, what kind of cascading impact does that massive price inflation have on the green energy transition itself, and which manufacturing sectors are going to feel that cost pressure first? See you all on the next Pro Ticker Deep Dive.